IRR. Not in today's world.
Well, you never could until the CDOs came around and lowered the cost of capital for everybody.
Right.
Barry, can I ask Mark a question? I don't want to take over the panel or anything.
No, go ahead.
But,
This is a user-friendly group.
Okay, but one of the things, because Lehman sets are coming back in the market, and that's great. One of the things that what you've been reading is everyone else exiting and dismantling. People are dismantling their CMBS infrastructure. So when the market does come back, I mean, it's good for you if you haven't done it, but how? Can you talk to how the market can come back fully with with everyone dismantling their infrastructure?
I think it's going to come back a toe at a time. I mean, we're going to come back in, and I think banks will pool together to securitize, because I think it'll take longer periods to aggregate the kind of critical mass to get to market, and it's slowly but surely. I think it'll happen over a course of a year, perhaps 2 years.
And that also brings one other interesting point that was touched on very briefly by the previous panel. In the old days, and when I say the old days, the 80s, when we did a large deal, put a large financing together, it was a $120 million or $150 million financing. It was never taken down by one institution. In the old days, we had to work, and if it was a $120, $150 million deal, we had to put together 4 or 5 institutions. It took longer, it was a lot more work, but that's the only way that those deals got done. We all got very coddled in the last 2 years because groups like Lehman could take down the entire 150 themselves. I think we're going to switch back now to do that $150 million deal. Yeah, where you're going to have to put together 4 or 5 lenders in order to make that deal. That's a major switch from where we were a year ago.
Yeah, I think in addition to that, you're going to see things like flex language come back. If you want to do a big deal, nobody's going to principal the return. It's going to be whatever the market is when we add up all the pieces. And it'll be what it is when I tell you I got it. Right. Nobody's going to commit long today on a big piece of money and say, unless they can balance sheet it, there aren't very many people that will balance sheet anything.
When are we going to be able to do spec deals?
In New York City, you probably could. I don't think anywhere else, though.
So you don't think so? You think it's going to be a long, long time? You need leases in place?
Yeah, like Jay said, I mean, there's no floating rate debt. I don't know how you do a transitional asset with 10-year fixed rate paper. It just doesn't make any sense.
You probably have to sign for it.
You're going to have to sign, and then you're going to have real net worth.
Yeah.
Not, other people's money. You're going to have real money. Or if you're a fund, you're going to be putting up fund level guarantees to get those deals done. And I think even when you start dipping your toe in the water, if you remember back when they were doing CMBS maybe 7 years ago, if you wanted a deal done, you might see language like it's contingent on selling a B piece at a certain price, at a certain size. And I think that's what you're going to start seeing again, is that they'll take the risk on some piece of the senior getting done, but they're not going to take the risk on the entire piece. And that might even be a $20, $25 million loan. They may say, here's the $20 million price this way, but I'll price it $25 million at $350 off, but that's contingent on me selling a $5 million B piece in the deal, because they may not be able to securitize that piece.
So you guys are saying that when we're in our office and we read in the New York Times about some great deal or whatever, and in Los Angeles Times, and we say, why can't I find a deal? You're saying to me you shouldn't feel that depressed because there really ain't a lot of that going on.
Barry, not only is there not a lot going on, but I'll take.
See, this is an upbeat lecture.
No, Barry, here's an even better thought. The deals that we all read about that get the headlines are Manhattan office buildings that trade for $1,500 or $1,600 a foot. Well, that's great, but who says they're going to make money on the deal?
Right.
There's a difference between doing deals and making money on deals. And that sounds like a silly comment, but I really think it's true. If you now look back over the people that have done deals in the last year, Barry, whether it's LA or New York or Las Vegas, I think if you're going into deals with that kind of a basis, and you look at a potential economy drop over the next 3 years. I think it's a legitimate comment that the next 2 or 3 years aren't going to be the most robust in our industry. I think you're going to see billions of dollars of equity that's been invested in the last 12 months get wiped out.
Well, you're going to see people lose money in real estate for the first time in 15 years.
Right.
And nobody was expecting to lose money in real estate. We all got accustomed to making money in real estate. You didn't have to be that smart. All you had to do was buy it, and you got rewarded. But now the intellectual capital is back. People are actually going to take real losses, and that's going to change values. And I think what you're hearing up here is all this debt has moved, and what you really haven't connected these dots yet is that how the values got driven up by the debt. And as this debt starts moving away, that's going to decrease the value of real estate because it's not going to be able, you're not going to be able to hit your numbers, your leveraged ROE, and that's going to cause the price decline. So even though the fundamentals are the same on the property, the NOI hasn't changed, the value has to come in order to be saleable in a new financing market. And that's the underpinning here, but that no one really wants to talk about. And those are the people who are realizing that are people that have to bring their property to market today and are suffering, a 20% price decline from when they bought it. And the rest of the world, is holding out. And that's why there's no trades.
My son-in-law was an MBA guy, and they told him to go with a hedge fund. Like, that's really where you should be. Now, my wife always thought that people who did hedge funds really didn't add much to society. It's not like you built the wall, it's just trading money. So I think I got to watch that situation.
But Barry, you got to remember one thing on the hedge fund side, though. The owners of the hedge fund, let's say they raised $1 billion, the owners of the hedge fund are collecting fees off the top on the amount of money that's been raised. So even if you're not investing and making big returns, the owners of the hedge fund are still in pretty good shape. It's not a bad advice for you to give them.
So you mean the money keeps rolling in?
It does.
Like Vita?
Well, that's the scariest part of our industry right now. You hear us all talking about, crying the blues, but yet there have been billions of dollars raised by these hedge funds. Where is that money going? What's that going to do to the marketplace?
I think they're all waiting for deeply discounted, distressed loan situations, and I'm not sure if they're going to see that, and they may have to lower their return expectations because I don't think they're going to give the money back.
I think they will see it in land and condos, but most of those guys don't want to go into land and condos. I don't think you see it in commercial. I think you see 90 cents on the dollar, 92, 95, something like that, but I don't think you see it.
I agree with Jay. The previous panel talked about some land deals where you can do that. Great, investing in vacant land and then holding for 10 years. I think that makes a lot of sense. But go try driving down Wilshire Boulevard or Park Avenue and finding distress. It doesn't exist.
So you mean those hedge fund managers get their 2% management fee whether they deploy it or not?
Correct. And it's a great business to be in.
I would say. My son-in-law's stock is going up.
But don't you think
But
that's,
except if you bought Blackstone, you lost half of its value in about 6-7 months, didn't it? And Apollo.
Wait, that was just one fund, though. Blackstone's got many other funds that they've.
That's true. So did Bear Stearns.
Yeah.
Oh, I shouldn't have said that because the guys who gave that rumor about, oh God, I should never have said that. The guys who did that rumor that Blackstone was going under several months ago are being investigated by the FBI. They're also looking at some of the well, they're not looking at Bear Stearns rumors because it happened. It's truth is a defense, I suppose.
Right.
But I interrupted my.